Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Welcome to the first in a special series of the Alpha Exchange, in which the 2020 economic and financial crisis is the specific focus. Amidst this protracted dislocation in markets, I'm pleased to have Benn Eifert, the founder and CIO of QVR Advisors, share his views on the factors at work within the equity derivatives market and the important drivers of option prices. Benn's insights on positioning in both vanilla and complex OTC products, his knowledge of the landscape of risk transfer trades that experienced substantial growth in recent years, and his expertise in the surface of equity index volatility are all highly relevant in an environment of explosive daily moves in both the S&P 500 and implied volatility itself. Thank you for listening. My guest today on the Alpha Exchange is Benn Eifert. He is the founder and CIO of QVR Advisors, a long-short relative value hedge fund focused on trading volatility. Benn, thanks for joining us today on the Alpha Exchange.
Hey, Dean, great to be here. Thanks for having me.
Well, we are in the midst of an absolute onslaught of volatility anywhere you look. Of course, market is driven by a rapid change in the fundamentals. You're an expert in looking at vol surfaces and implementing trades that express views on volatility. I'm curious, as you sort of step back and look at the last month, describe for us in your world the degree of dislocation that you're observing. What are some of the things that truly stand out to you so far, kind of a month or so into this crisis?
Yeah, absolutely. So, as you pointed out, this crisis manifested itself in a big sell-off and vol spike that was very fast, much faster than most relatively recent crisis events that we've had, say, over the last 10 or 15 years, including 2008, which was more of a slow-building crisis that came to a head with Lehman, right? Partly as a result of that, we've seen extraordinary spikes in short-term realized volatility, right, to levels even higher, arguably, than the peak of realized volatility in the credit crisis. So you're talking about 10% moves, 5 to 10% moves every day to some extent over the last couple of weeks. Call it 100% short-term realized vol order of magnitude, right? You've seen on the back of that very extreme spikes in short-term implied volatility, with VIX closing, I believe, I forget what, 79 or 82 was the high, but higher than in the credit crisis. Short-term at-the-money vol extremely high, and a weekly vol in the 100 range. And that's right. People think it's high and they try to sell it, but when we're moving 10% a day, you can't sell 100 vol, right? You've seen on the back of that, initially, also fairly big moves in medium-term implied volatility. And you saw a lot of liquidation of hedge fund portfolios. So favorite crowded carry trades that people had on that were short S&P variants in the 1-2 year bucket getting blown out. And you saw that the whole curve come up quite a bit. But then subsequently, after a lot of liquidations of big hedge fund portfolios, you saw it float down. We're still in an environment with very extreme term structure inversion, where 1 month vol is well above 99th percentile versus a long-term history. But 2 year vol, for example, is fairly average. And I think there's various reasons for that we can get into. And part of it is just the nature of the path of how fast this has happened. And I think part of it is just people haven't really processed the medium-term implications of this kind of real fundamental economic shock and how long we're going to be in a state of heightened uncertainty.
I was going to say, it's clear the economy hit a brick wall in a way that is truly a black swan type of event. It's difficult to surmise this sort of a sudden stop. I'm curious, as you have traded through outlandishly high vol periods and those that are in some ways outlandishly low, how much of the move in asset prices, you were talking about some of the very common and crowded trades that were set up going into this, how much of the movement in asset prices and in vol do you attribute to be a function of the broad setup going into this? Of course, again, we hit a brick wall, but there are trades and the characteristics of the system going into this that might play a part in it as well. How do you kind of disentangle those two?
Yeah, very much so. I think on one hand, there's just the absolute level of risk assets in terms of where's the S&P and where are credit spreads. And to your point, there's a lot of fundamental justification for big moves lower in those levels. But a lot of the crazy price action we saw in derivatives the last 2-3 weeks was very heavily driven by extreme fragile positioning coming in. So on the derivative side, I mean, we've had really 10 years of gradual bull market environments with relatively low volatility and brief bursts of volatility that very quickly receded and asset prices that very quickly bounced. And that over this period of time, particularly over the last 3-4 years, has really attracted a large interest and participation in extremely dangerous carry trades that we saw lots of hedge funds and asset managers come into. And I'll give some examples. But I think one big important theme here and a distinction from 2008 that's important is 2008, banks were taking a lot of risk, had a lot of tail risk in their portfolios, and were under a huge amount of pressure. On the back of that, taking huge losses from asset price movements in 2008, we implemented Dodd-Frank steadily over the last 7-8 years. And the result of that, the end game over the last 3-4 years, is that banks have been really very de-risked, right, with extremely tight stress test requirements, very detailed analytics on their slide risk, and not able to hold inventory. And they've created programs that the various euphemisms called alternative risk transfer, or ART, for example, with dedicated salespeople within banks and dedicated teams for laying off tail risk inside banks to hedge funds, asset managers, more sophisticated pension funds, right? Those programs started in 2013, 2014, and became very popular and attracted a lot of attention after 2016, 2017. And you just saw every manner of toxic tail risk, flavors of different short variance types of trades, both really short term, a lot of effectively caps on variance or call options on variance that banks were buying from hedge funds. Lots of long-term S&P variance, either outright or as spreads against other products, skew locks, hedge funds selling banks, variance conditional on a large down move in the equity market versus buying variance conditional on an up move on the equity market. These trades were huge and very popular and very profitable for the last 3-4 years because we haven't had a major volatility event. And here you saw billions and billions and billions of dollars lost on the buy side very quickly on those positions. Liquidations of many hedge funds, of many large portfolio managers' books at multi-strat. And that risk really covered the banks. So the banks actually did fairly well throughout this whole process. Flip side of that was this huge short squeeze in volatility risk parameters in the liquidation of all of those portfolios.
One of the things I think you've alluded to is over the past many years, and maybe it's the peak of QE, the previous QE peak, that saw folks just trying to generate yield, generate some carry in a market that had very little yield. And as you said, was relatively well behaved. There seems to have been a democratization of short vol, that you can flip a switch and face your favorite broker dealer and they'll deliver you essentially the vol risk premium that you're short in a very easy way. You don't have to have the technology that someone like yourself, an expert, has in terms of being able to trade the underlying and all the systems and so forth. Bring to life for us that democratization, the whole alternative risk premium, the growth of that industry, put selling and so forth. How would you characterize that? And is there a way that you can quantify the extent to which that got bigger and bigger over the years?
Absolutely. So I'll put it in a couple of different categories. So one category is what I was referring to as the ARP programs at banks, which really were the structured tail risk selling programs. Another bucket I'll put potentially more vanilla volatility trades like dispersion, for example, although many people might not call that vanilla. And then the third bucket, sort of institutional option selling, call writing and put writing. So the first bucket, the ARP side, it's tough to get great data on this stuff. There's been really spectacular growth on those bank programs to buy back tail risk from hedge funds. I mean, my best estimate, for example, so one explicit trade type, banks buy uncapped variance from hedge funds versus selling capped variance. The reason for that flow was originally some of the large pension funds in the North liked to sell capped variance as a risk-controlled way of generating yield, and the banks needed to recycle that cap risk. So effectively, hedge funds are selling a call option on variance struck at 2.5 times the reference price. Right? I think that there was probably an outstanding, and those are 1-month trades, the outstanding notional, Vega notional on those type of trades was probably somewhere in the 10 to 20 million Vega range. And keep in mind, those are trades that would have lost on the order of 250 times their Vega notional on this realized volatility spike. And that's dramatically bigger than, say, when those trades first started going up in 2013, 14, when we think maybe there was 1 or 2 million Vega of it. So that's a ballpark 5x increase. And then there's a whole dramatic set of this type of stuff in that book. Also corridor variance spreads, which are very popular, which we think the outstanding Vega notional of international versus S&P corridor variance spreads was up to as high as about 400 million Vega of notional outstanding, which is enormous number, even though that's longer dated 2-3 year stuff, where that would have been maybe 20 or 30 million back in 2014, 2015, in the early stages of those products. Now, in the second bucket, in exactly to your point on this is really the democratization point. Dispersion is a relatively complicated trade, right? You're buying lots of volatility on lots and lots of names in a very precise way and hedging with index. The dealer innovation was, well, we have an ISDA with this client. Why don't we just offer them an OTC product, which is a dynamic strategy that just delivers dispersion in some specific format under the hood to an end client and charges a fee. And from the client's perspective, it's just a total return swap. So this makes the most complicated volatility strategies potentially very risky, depending on how they're structured, just, tradable by saying done in a Bloomberg chat, and not just one-off, but dynamically for a large period of time. And the size of dealer manufactured packaged dispersion trading was in the many hundreds of millions of dollars of Vega, if not $1 billion of Vega. I think if you probably need to get to $1 billion, I think you do get to $1 billion, you're probably then counting people who are actually managing dispersion strategies explicitly across a lot of different portfolios. But these are just huge sizes. And by the way, many of those packages had in them caps on single name variants. The ones that were variance swap oriented had caps on the single names and no cap on the index. And in that case, the losses were astronomical in this environment. Then on the third bucket, which really has been the largest growth in volatility selling over the last 7 or 8 years, really the institutional short-term option selling in the context of call overwriting and put underwriting out of pension funds. This I've talked about a lot over the years. It's much less scary in terms of these are not tail risk trades. This is a pension fund that owns some stocks, selling some calls against them, for example, or replacing a long equity position with a short put 5% out of the money. The implications of that, so those trades we've seen growing steadily over the last 7, 8 years to an estimate of something like, up until recently, as large as 800 million Vega of front month, vol being sold every month, which is just a huge number. And our view and our data, and I think MRA had some similar data, basically suggests that the sizes of this flow pushed the gamma risk premium, or the short-term implied realized risk premium in the S&P, to more or less zero, or anyway, some very small number, versus historically being maybe 3 volatility points or something, right? So when these institutions and the consultants that help them looked at the 30-year back test, they say, God, this looks great. And then you just have this huge sea change in the performance of those types of strategies versus relative to the S&P that started relatively soon after the huge institutional inflows into the space.
Yeah, that's super helpful. When we think about a shock and the magnitude of asset price movement, there's the market has been hit with new information, which it clearly has been. And then, as we've been discussing, it's the setup going in. How much of the reaction do you think is the short vol? There's always short vol in the market. Risk taking is about selling vol. But the question is it in the hands, or is the exposure in the hands of folks who are forced to react? So you were referring to pensions before. You can imagine a pension that sells some complex, generates some risk premium by selling correlation, but just tucks it away, isn't really subject to mark-to-market risk, and is in there for the duration, 3 to 5 years. And then there's the more mark-to-market sensitive vehicles. How much of the risk do you think has been in highly mark-to-market sensitive hands? And has that been a big part of the degree of dislocation?
Yeah, I mean, a good percentage of it, I would say 50% at least, was in weak hands, and that's all gone. There were liquidations of entire hedge funds and many multi-strat PMs. I would say anyone who was dangerously short S&P variance was liquidated. There were people seeing banks making markets 20 vol points wide on a December 2020 variance swap, and people were lifting their offers. Those guys are all dead. And then you saw that basically that was last Friday. Monday, you started to see, right, you were seeing just really crazy liquidation level pricing and trade and action in the volatility marketplace. And then the next few days, even as we sold off, but then started to rally, you saw that wind kind of come back out. And then you saw a bunch of new vol selling come in, but I think much, much different stuff. I think what you're looking at now is a market where, for the most part, the bombs of over-leveraged positioning are gone. And it's hard to argue. I think there's plenty of dislocations that are interesting left in volatility, but front-month vol is at 60 for a reason. It's not because there's still people getting liquidated. It's because we're realizing 100. And I think you want to think about the current environment as predominantly dominated by what's going on in markets and the supply and demand that you see, not by forced liquidation of weak hands. I think that happened largely the week before last.
The amount of capital that seems able to essentially take either a long or a short position in equity vol seems pretty flighty. As you've noted, folks have gotten blown out. Even as the market's realizing 100, it's no gimme to buy vol at 65. It won't take but a couple of days of 1% and 2% moves, which are big historically, for you to lose 20 vol points. How does someone manage a vol of vol environment like this? It's almost as if vol is a hot potato. You can't get enough of it, or you can't discard it quickly enough. How has it been to trade through an environment like this?
Our core business is an absolute return mandate. I think it's extremely hard to be outright long vol or outright short vol and making guesses in this kind of environment. From a relative value perspective, we're always thinking about what specific trades make sense in this environment, what types of themes make sense in this environment that take advantage of the opportunity set that we're given. Separately, we spend a lot of time helping large institutions think about their portfolios and how options and derivatives can help tune their risk-reward profiles and what they want to do that might be more directional, but in the context of their broader portfolios. And in that world, some of the types of things that I would say, if you're thinking about just pure play hedging, stopping out downside equity risk, you missed the boat on that, right? That was a conversation for 2 months ago. To your point, we're talking to someone the other day who wanted to know, what does it cost to stop yourself out down another 20% in the equity market? And the answer was, at the time, end of the year, 20% down put was like 8%. So the markets could be down 20 and then you're going to be down 28. This is not a good risk reward for any asset owner. You have to be thinking more creatively about how to achieve your goals. It might be, for example, looking at, in the context of an asset owner's portfolio, things like, at this point, now that volatility risk premia on a forward-looking basis might start to be much higher, replacing some equity with notionally unlevered put selling to give yourself a buffer to the downside, giving up some of the V-shaped recovery potential for better carry and better buffering to the downside, things like that. To your point, no volatility manager, no matter how good, is going to have any edge on guessing whether volatility goes up or down the next day and punting on directional positions here.
One of the reasons why vol has seemingly moved around so much, and asset prices along with them, as you said, these forced liquidations, but also maybe the ETP complex, which of course via the XIV in early 18 asserted itself dramatically on the vol spike back then. And more recently, there just seems to be, maybe it's because the market itself is fragile and thin, but I was just looking at the TVIX market cap. I think in the course of 3 or 4 weeks went from 500 million to 5 billion, kind of back from the dead, at least for a couple of days or so.
Yep. And that was returns, not inflows, by the way.
Right. How much of that are you keeping track of, and how big an impact does the mechanical flow from these vol ETFs matter?
Yeah, no, it does matter, actually. If you had asked me that question 2 months ago, I would have said it doesn't really matter because, to your point, those ETFs were much, much smaller. in the wake of 2018 when the vol ATP complex really blew up. But now, one, liquidity conditions are worse, so any given amount of trading is impacting the market much more. And two, the retained P&L in something like TVIX has been massive. If anything, actually, the flows have been, unfortunately, from many sides, I think both hedge fund and retail, to try to be short something like TVIX, which is extremely dangerous in this kind of environment, right, with a very steeply inverted VIX curve. And you've seen this dramatic roll-up consistently as the crisis has continued and volatility has been elevated. And so you've seen TVIX now $5 billion. And so we certainly watch TVIX, which is the biggest impact, in some of the other ETNs in the context of what are their NAV discounts doing, because that tells you what uninformed money is pushing on a given day. There can be opportunities there. And also in terms of the rebalances, at the end of the day, the trick there, everybody knows about this. So it's not as clean cut as there will always be momentum into the close, for example, in VIX futures driven by TVIX, because you'll see large investors try to get ahead of that and push the trend first. And then TVIX, by the way, the issuer doesn't have to just hedge at the end of the day. They can actually do some pre-hedging. They have the authority to use some discretion there. And then you can see actually like vol get crushed right at the end when the people trying to front run the TVIX rebalance have to go back and cover. So it's not as straightforward as you might think. But if you look closely at that data, there's real big volume, obviously, that's having to go through. And you should be paying attention to that.
Last question, because you touched on it, just in terms of the TVIX and the term structure of S&P vols impact on how the ETPs function. Walk us through, as you've observed the S&P term structure, what you see, what's driving the inversion, and then if there are any historical analogs that folks can try to isolate in terms of how long the disinversion typically takes, what your expectations are for how long we can stay inverted. That'd be great to finish with.
Yeah, absolutely. So we've seen several historical volatility episodes. Every one of them is different. 2008, 2009 was a relatively protracted crisis. We did stay steeply inverted for several months. The way that eventually resolved was that even as the equity market continued to go lower towards its lows, realized volatility calmed down somewhat from the 90, 100 range to the 70 range and to the 50 range. And you saw VIX spot falling, but at the same time you saw, and the inversion at the front lessening, but also you saw eventually a very significant bid for the belly and the back of the curve. And so eventually you ended up with a term structure that was relatively flattish in the zip code of 40 after a period of several months. So that's certainly one type of path that can occur. 2011 was a somewhat smaller volatility event than this, right? I think we peaked the VIX around 50. In that event, similarly, we had dramatic inversion initially. The middle and back of the VIX futures actually reacted faster, though. So within even a month or so of the initial shock and the initial sell-off, you started to see significant flattening of the term structure. And similarly, you did end up with the VIX term structure relatively flat in the mid-30s, for example. Here, we did get to the mid-30s in the back very briefly at the liquidation wides, but that was in an environment where actually large VIX portfolios were being liquidated and the VIX futures were trading extremely rich to the underlying S&P vol. And at the time, the VIX spot was in the 80s. So we're still in an extreme level of inversion. In terms of the mechanics of the product you asked about, right? If you have VIX 60, 65 or 66 and the front month VIX future at 50, and that future expiring in 2.5 weeks, you already have the market essentially implying VIX falling by 1.5 points or 1.25 points every day for the next couple of weeks, right? So ultimately, whether or not that's a reasonable forecast depends on the realized volatility environment. Most people just intuitively think that it's just not possible for volatility to stay, high for long. I would argue that the nature of this crisis is fundamentally a crisis of broken markets. The flip side of what I said about the banks being in pretty good shape because of Dodd-Frank and really tight stress testing and no inventory is that banks are not facilitating financial markets right now. What we're seeing right now is financial markets under stress with no financial intermediation or very limited financial intermediation. So the Fed and regulators are taking actions to try to alleviate that, including allowing banks to take more risk, but this is going to be a gradual process. Look at how the market trades 10 minutes into the close when the market on close number comes out and we just gap 3% on it. Are we going to go back to VIX 30 in a couple of weeks? I would say absolutely not. Right? And you see that with 10% rallies to the upside, everybody's confused about why VIX is not coming down. You would never short VIX at 60 with 10% moves, or you're already out of business if you do. So I think expect term structure inversion to continue and for resolution of that to only come slowly through most of the term structure going higher in the middle and the back, and eventually realized vol calming down and the front coming down. But I think it's really going to be driven by that realized volatility dynamic.
Excellent insights, Ben. It was great to catch up. Thanks for making yourself available and sharing your thoughts, and be well.
Dean, thanks. It was a lot of fun. Appreciate it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.